Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Qian Wang, Chief Asia-Pacific Economist at Vanguard Group, to take a closer look for the Asia-Pacific. We'll take a closer look at global markets here. Qian Wang, thank you very much for being with us. Let's start off with China. We can go back to the U.S. Perhaps in a few moments. We have this NDRC announcement coming tomorrow. Just a little bit of connecting the dots on some of the stimulus. Should we expect a lot more clarity here in terms of what's happening?
Thank you so much, Doug and Brian. Thanks for having me today. I think, having the NDRC pressing tomorrow, right? Like right after the golden holiday, the timing itself can be sending a positive signal, and that the Chinese government is really moving fast because, frankly speaking, they are running out of time trying to reach that 5% target of this year, right? So that actually is positive news. But on the other hand, I think we do need to figure out, in terms of the size, in terms of the composition of the further, support measure, right? Hopefully, they are going to emphasize on, a better utilization of the existing fiscal space, as well as, hopefully they can announce a supplementary fiscal package that will be approved by the National People Congress later this month. There is certainly a lot of hope there, right? Currently we are expecting about a 2 trillion, right, fiscal package, supporting consumption, some investment, alleviating local government debt burden, and probably some injection to bank capital. But I think that remains to be seen, right? And I think investors are waiting to figure out whether this is really a whatever it takes moment or still a continuation of just enough approach.
Do you think we're going to see sentiment move in a positive direction as soon as some of the high frequency data from the Golden Week holiday, if there is to be positive sentiment from the consumers in China at all?
Well, I mean, if you look at there's some high frequency data, right? Like the box office, like the travel, railway tours, railway passenger, outbound, inbound trips. Some of the number actually do see, positive year-on-year growth. And also, I would say in tier 1 cities, we do see some boost to the housing market sentiment and activities after the, coordinated policy pivot in, a week ago, right? So, but I think at this moment, a lot of people are still rather skeptical, because see, when I think about policy stimulus, right, I think there are 3 stages of policy support. The first stage is really about supporting the liquidity and sentiment. And of course, I think they already done that, right? But the second stage is then when the economy is really in a liquidity trap, what is it missing is really credit demand, not credit supply. And monetary policy or injecting money into the equity market does not really solve that. So that's where we get into the second stage, really focusing on the fiscal policy. But still, I think cyclical policy does not really fix structural issues, right? So I think the third stage is really we need to see what the government is committed to solve those fundamental issues.
Yeah, that feeds into the reason I was kind of, getting, on the edge of my seat was I was thinking that there's a possibility that there may be a kind of permanent discount placed on China, given that we've seen now that it comes down to one-man rule. And I think a lot of investors really have their doubts that Xi Jinping is really all behind this. He's kind of being dragged along here a little bit because of conditions and such, but that he may not be fully committed. Do you think that permanent discount could be in place?
Well, I think there's a lot of skepticism, and I think this is why at this moment is really a critical moment for the Chinese government, right, to regain their policy credibility, right? So if the policy support just continue to be, moderate and just enough, then I think that may actually make a lot of investors more disappointed. At this moment, I see like two fundamental issues in the economy. One is really on the housing sector, right? I mean, unless the central government is willing to leverage its own balance sheet to address the oversupply issue, right, or the unfinished housing, unsold supply, and even land that's sold but not developed. Unless central government is willing to do that, I don't really see that they can stabilize the housing market in a sustainable manner. And the second issue, I think, is ultimately business confidence, which matters the most actually for household consumption, there, because I think the most important factor to drive consumption is really the job and income prospects. And that's where I think the government needs to revive the animal spirit and business confidence, especially in the private sector.
That is a very good point, and I'm curious to get your take on why the government has not yet used its balance sheet, whether it's the central bank or other means. I'm assuming what you mean is that the PBOC would put its balance sheet, not necessarily at risk, but would certainly add to it in a substantial way. Why do you think there's been so much resistance to that idea?
Well, I think at this moment, a lot of people were expecting a bazooka, package, right? But I think in China's government's mindset, probably they still want to follow touching a stone and crossing the river, right? I mean, because if you look at the Chinese government, what we have seen over the past several years is that they are trying to balance multiple policy goals, right? Growth rate is one thing, but growth quality, financial stability, and income and wealth equality. There's many other goals they're trying to balance. Yeah. Oh, yeah, right? Yeah. Tech development. Yeah. So I think that's where they do want to watch closely, say, okay, we want to support the economic growth for sure, but we don't want to overstimulate it, and that actually could threaten the financial stability down the road.
Okay, let's circle back quickly to the U.S. because that's also a big important part of all this. How should we interpret the stronger data of late? A good thing or a worrisome thing because of the inflation implications?
Well, I think definitely this is actually suggesting that the U.S. economy is, pretty resilient, right? Surprisingly resilient, in fact. So I think that does calm the recession fear and move the risk to the upper side. Still, we don't really expect a soft landing or a no landing, actually. We still expect the economy to have a landing in 2025, what we call a turbulent landing, which means we are going to see some below trend growth, like average 1% next year. And that negative output gap will be able to bring inflation, towards the 2% target, right? So this is where we're still, expecting for the Fed to,
little sobering position there.
Turbulent landing, right?
Yeah,
Buckle
exactly.
up.
I was getting all excited, and then Qian Wang had to pour some cold water on us. Anyway, but a very nice conversation. I think I learned a lot, and Doug too. Qian Wang, Chief Asia Pacific Economist at Vanguard Group, looking at the Asia Pacific and a little bit on the U.S. economy. Will McDonough, founder, chairman, and CEO at Corestone Capital, for a closer look at markets. Will, the U.S. economy, with this latest data on jobs and some of the other data, we are going to see higher yields. That seems certain. Are markets ready for that?
I think markets are realizing that the data that's coming out today is at a significant lag to the reality. We liken it to the adjustment of your thermostat in your home. You might change the degrees in the morning to be up a little hotter. It doesn't get hot immediately. It takes a little time for that to adjust. It's the same when you see interest rates adjust. It's the same when you see Fed activity. It takes a while for that data to get into the market. And so why I think the markets reacted positively this week is because we are very close to the first adjustment from Powell with the cut to see data this close to that, so positive, it's leading people to believe that maybe things weren't as bad as we might have thought over the summer months. And so if we follow that up into the new year with a couple more cuts, people seem to think that we might get some momentum into the new year. And I think people are really hoping for that.
Bloomberg spoke with Ed Yardeni last week, and he was saying the Fed might not cut again this year. Is that too bold a statement?
I think it's too bold of a statement. We're predicting 1 full point for the year, so they're halfway there. I think if we got 2 more 25 BIP cuts into the year end, I think that's kind of what the market's expecting. And I think if we got less than that, the market might react negatively to thinking that they're not doing enough.
The chief consideration must be, or the chief concern must be, that you get a pickup in inflation with this added growth. I mean, if we are reinvigorating and re-energizing in the economy, I mean, isn't it a fear that inflation picks up with it?
I think that's a good fear. I think that's a well-warranted fear, and that's a real fear, and that is exactly what could happen. The problem with this Q4 in the traditional economic calendar is we get way better real-time data from consumer spending around the holidays, and that's our real litmus test for how much money is in everyone's pocket, how much money are they spending, and when we start to see those numbers between now and Christmas and the holiday season, if those numbers are off, that's going to strike a ton of fear into people. And so I think markets right now are in a little bit of a wait and see to see how these numbers spit out. And they want the Fed to continue to lean into it because we don't know what we're going to see. COVID era savings are down tremendously. Inflation is still up massively compared to where it was pre-COVID. And so those two things don't line up for a big holiday season of spending. And that could prove to be really hard as we roll through Q4.
So key data this week will be CPI, PPI, Thursday, Friday, respectively. Do you have a sense of what we're looking at here in these numbers?
I mean, they're going to be at a lag to the reality. And so, while markets are going to make bets on whether or not that's going to come in hot or not, we actually zoom out a little bit more. I'm less focused on, this week over week, month over month number, because it's really reflecting August, July realities. And so I'm way more concerned and focused on the holiday season, and how that's going to affect the global macro environment. We can't forget, between now and holidays, we have a pretty contested election cycle where the economy's front and center. And so you're going to see, I think, a lot of the focus go away from the numbers and the tangible numbers because those are going to be less real time. You're going to see how the U.S. markets are voting truly at the polls and therefore with their wallets. And then you're going to see right after that how they're spending at the register. And that's going to give us a real true test for the realities of the U.S. markets.
Have you been thinking about China and the strong impetus there for market action, reflecting the change in policymakers' approach to things? Is that something you like, or are you in that camp that's a little concerned that it's moved too far too fast?
I think about China more often than I care to admit. I'm horrified by China. I think it's amazing that what they're doing. I don't trust a lot of data that comes out of China, but when they are leaning into and throwing the kitchen sink, if you will, at their own economy and trying to stimulate things, that does reverberate around the globe because of how much we depend on their output and how much we depend on their exports and how much they define, the cost structures of a lot of goods that travel around the world. And so, China does keep me up at night and wake me up in the morning. And when they do things like they're doing recently and really come over the top with their movements against their own economy, it does make me a little bit fearful about the realities under their hood.
Hard to believe we're already at earnings season this week, right? Delta Airlines on Thursday, some of the big banks Friday with, I think, JP Morgan and Wells Fargo. How do you feel about the earnings season?
I think that the consumer activity through the summer is probably going to be fine. I do think that the banks are going to be a better litmus test because the data that they're going to be reporting off is going to be the last segments of the market, hopefully with high interest rates. And so how did they operate in a high interest rate environment? Because when interest rates are coming down and interest rates are good, banks do well. People are borrowing, people are engaging with the markets more. And when interest rates are high, that's when things are really hard on banks. Activity's down a lot for them. Transactions are down, M&A activity's down, investment banking activity's down. And so I do think that those banking numbers that come out this week are going to be important to monitor. And I don't predict that they're going to be spectacular. But if they are good, I think that, paired with the election cycle and people's promise of maybe some economic policy shift, and like I say, the consumer activity into year end, we're going to come into this new year with a really good grasp on where this economy stands, and I'm truly hopeful for it.
Well, the big bull case would be that, you've got the Fed leaning toward cutting interest rates into an economy that's not only okay, but seems to be reaccelerating. And then you've got all this stimulus that's coming in China. I mean, you can make the argument that this is a unique and very interesting period for taking on risk.
It is. And one side of the coin is that that's a house of cards with a lot of different stakeholders who have a lot to gain from their own personal activity, and those are compounding off of each other. But the other thing is, we can't be negative about the fact that the data and the CPI and, the non-farm payrolls, and those have been stronger than people thought they would be. And so it's giving people hope that maybe some of this political activity actually did, keep things afloat through some pretty trying times. And if we do come out of that on strong footing, you could predict that the market persists in the right direction. And it might just go down as a case study for how to handle a crisis. Which I'm yet to celebrate that, but you are correct that it has the setup, to be a win.
It's kind of amazing. I mean, so far this year, I think the S&P is up roughly 20%. $8 trillion added to market cap. A lot of that has to do with the AI trade. How are you feeling about mega cap tech, AI in particular?
I'm bullish on mega cap tech and AI and its influence. I do really spend a lot of time trying to figure out where the energy is going to come from to support all of this computing power necessary for AI. We're spending a lot of time, assessing that, and think that, we made a big move into copper last year, which has performed well, over 17% year to date. And we think copper will continue in that direction. I think the two different sides of the aisle have different energy policies, and those policies are really going to drive actually tech earnings, which is just a crazy commingling that, more so than ever, because of how much computing power these large language models require for AI and the queries that are coming from it. So I do think that the haves and the have-nots are going to become more pronounced, and those with big balance sheets like the big techs have will continue to succeed because they're able to lean in and double down, and we're feeling good about that.
All right, Will, thanks very much. Will McDonough, who is founder, chairman, and CEO at Corestone Capital. James Abate, Managing Director and Chief Investment Officer of Center Asset Management. James, how should we interpret the stronger economic data that we've seen here of late? Good news, because it seems like good news, or worrisome in that inflation might get restoked?
Well, it hasn't been uniform, right? The ISM Manufacturing Index released last week continued to show a great degree of weakness in the manufacturing segment of the economy. And clearly the labor report, which showed a gain of 245,000 jobs, and as you pointed out, the unemployment rate falling down to 4.1%, kind of puts us back in the no landing environment at this point in time. I think there are, three issues that one can take exception to. I mean, the first is that when you drill down into the numbers, the average work week actually fell. So the aggregate number of hours of work actually declined in the most recent report. I think, two, nearly all the job growth was in government, education, and leisure. So it's essentially a bull market for job growth in bureaucrats and bartenders, I guess, because if you look at the manufacturing sector, it actually declined by 7,000. So, we're seeing the fiscal stimulus continue to offset cyclical and private sector weakness that we have. And, going back to that ISM report that we had earlier in the week, if you look at the subsector, which is the ISM labor component, it showed the biggest drop since the COVID lockdowns of mid-2020. I mean, that's a real indicator. That's something consistent from business, which is very consistent with the Fed's Beige Book. It's not a statistical figure released by the Department of Labor, who, I hate to say it, I don't want to, question their credibility, but, just last month, the same Department of Labor revised the number of jobs down by 800,000 lower. So, we'll have to wait and see, because if you look at the bottom line, the fear of recession may now be on hold for the time being, but it's not gone completely, as the global economy seems still to be stuck in first gear. We saw Germany GDP estimates coming at negative 0.2%.
Yeah.
And I still think we're vulnerable to some type of demand shock and have a hard time seeing a rapid acceleration of economic and profit growth.
But for the moment, does it change your thinking into what the Fed may do next? Ed Yardeni was saying last Friday in the wake of that jobs data, hey, the Fed may not cut again this year.
That's possible. I mean, we've never been sitting here with the pom-poms out cheerleading that the Fed, needed to go another 50 basis points. Our guidepost has always been the 2-year note, and the 2-year note right now is around 4%. And we've said if the Fed can get to 4% on the Fed funds rate, which it's still not there yet, and whether that's in 25 basis points increments or, maybe even less, and depending upon the time, that would be an ideal situation. I mean, what you're thinking about at that stage is 2% inflation and 2% real rate, which would be, theoretically, monetary policy nirvana.
So I'm a little confused on whether or not you're concerned about the future. It seems like with your first answer, you are a little concerned about the U.S. economy, yet you don't really think that interest rates are needed, which might suggest that you're more like it's kind of cruising along sideways here, and that's not such a bad thing.
Yeah, that's exactly right. I think that the market has already priced in much of what's occurred in terms of easing. I mean, let's look at large corporations. They're doing fine. I mean, credit spreads relative to treasuries are already very tight. There's no indication of any kind of financial stress. I mean, if you look at ratios, at least total debt to capital, they're at cycle lows right now for the average S&P 500 company, as is the debt to EBITDA ratio. I mean, when you think about it, providing the rally that we've seen in bond yields, it means provided some benefit to regional banks. I mean, the biggest beneficiary, let's cut to the chase. I mean, the biggest beneficiary of the cut in interest rates is the U.S. Treasury. I mean, the average maturity of the enormous $35 trillion U.S. debt is, 6 years. So U.S. deficits are highly impacted by the cuts of short-term interest rates, as interest costs now top $1.1 trillion a year. It's a quarter of the federal budget. So, I mean, unfortunately, if you look back, Treasury Secretary Yellen is probably the only person in the country who had a huge mortgage and didn't lock in low-cost, long-duration funding when the opportunity was there in 2021, and 20-year bonds yielded less than 2%. I mean, Alexander Hamilton is probably rolling in his grave over this blunder by the Treasury.
Yeah, but to be fair, anything that's on the Fed's balance sheet in terms of U.S. Treasuries, I mean, that money goes back to the Fed's account at Treasury. So the Treasury is a little bit of a winner there as we still unwind the balance sheet. How are you feeling about earnings right now?
I mean, earnings right now, expectations for Q3 are relatively modest. They're about 5%. My biggest concern is that when we look out to 2015, the estimated earnings growth rate for the S&P 500 is 15% for the full year. What we have a very hard time reconciling that number with is the fact that most companies that we're analyzing from a bottom-up perspective are, cutting back. They're cutting back CapEx. They're cutting back on employees. They're restructuring. We're not seeing the pricing power that was evident a couple of years ago. So 15% seems to be a very high hurdle rate, and we think that we're at a point in time where this concept of disappointment is quite evident. And given where the market is trading at 22 times forward earnings, we think that you could see some type of either time correction or maybe even a price correction in indices if guidance this quarter is not as robust as perhaps the market anticipates.
One of the things we teased that you'd be willing to talk about was what some people might think is a terrible idea to tax unrealized capital gains. And you pose the question, is there merit to it? What say you?
Well, when you think about it, I'm probably very unlike other people that you talk to, but I think there's actually an argument for taxing unrealized capital gains above a certain threshold, and if the person is simply borrowing against stock holdings for consumption. I mean, frankly, should Jeff Bezos of Amazon not pay any income taxes like he has over the past several years? There's a court case going back to the Supreme Court in 1916. It's Eisner versus McDonough. It regarded a stock dividend, and the Supreme Court ruled that a person needed to physically sell an asset, a stock, bond, or a building, whatever it might be, and reap some money before it could be taxed. But when you look at some of these tech moguls, right, isn't paying yourself $1 in salary like most of these guys do, but then getting sweetheart borrowing arrangements like we saw with Silicon Valley Bank from these lenders, against your stock holdings to fund a lavish lifestyle like Bezos does, constitute a de facto sale subject to a capital gains tax. Also, when done perpetually, I mean, their estates will avoid taxes in entirety due to the step-up rules. So I think it's probably fair, and I think the Democrats are likely to challenge us if they take Congress in the next election.
That seems less clear to me at this point. I mean, there's a chance maybe that the Senate goes Republican, maybe the Democrats do take the House, and who knows what happens at the White House. Yeah, I think
the other thing, the other impediment is that the Democratic donors are very much of the tech billionaire crowd. Do they want to basically turn on their own donors?
All right, good point.
James, thank you so much for joining us. Always interesting. James Abate. And we didn't even get a chance to talk about utilities and 3 Mile Island and Microsoft. Anyway, next time. James Abate from Center Asset Management. Adam Coons, Co-Chief Investment Officer and Portfolio Manager at Winthrop Capital Management. So we've seen this bump up in yields that could be just reflecting a better economy, which is sort of reflected by the recent data. But it could also be some fears now about inflation kicking back in. How do you see it, Adam?
Yeah, I mean, I think it's a mix of both. I think, the reality is the economic data still is showing that the U.S. economy has plenty of strength. And so as you see the possibilities of the Fed cutting rates further and how much they're really going to cut, and what the effect of those cuts will be is what's kind of pushing yields higher. I mean, obviously, the short term, but when you have things like this hurricane and some of the labor issues with, just different unions shutting down working, that can be inflationary in the short term. So I think that's some of the fears. And then the other fear is just that, frankly, the Fed's not going to cut nearly as much as some have forecasted, because when you look at the labor data, it's still showing some strength, and then the consumer continues to be strong. So it's really just this kind of everyone's trying to find a clear crystal ball into what Fed policy is, and really how much they're going to cut rates, and like I said, how that's going to affect inflation through 2025.
Do you think we're going to get any more rate cuts before the end of the year?
I do. I think, originally markets were pricing in another 50 to 75 basis points through the rest of the year. I think the reality is probably one more cut, 25 basis points, is probably all we're going to get, unless there's some significant data point, showing that labor is deteriorating quicker and that the consumer is really tapped out. But there's not enough time in the year. There's not enough data points that I think can push the Fed to justify that a move greater than 25 basis points.
So, Adam, I mean, we look at this as a trade-off, because if you don't get as much in the way of rate cuts, obviously that doesn't lower your cost if you're a small and medium-sized company as much as you perhaps had hoped. But a better economy means the top line is going to look a lot better, right? Don't you think most companies would prefer this environment with stronger growth and a more solid economy than they would with, marginally lower costs if you borrow money?
Yeah, this is one of those perplexing pieces of capital markets where good news is somewhat bad news, because I agree with you is that overall, a stronger economy should be better for everyone. And what you'll see is, kind of market volatility is picking up, and you'll see equity markets roll over.
Especially at a time when you were worried about growth. I mean, we had a growth scare in
Right.
August and early September. So, that's what I mean is like, oh, okay. Yeah, this is different.
It is. And so, I think it's just because so many people are trying to bet on what the Fed is going to do. And when they get that wrong, I think they're more worried about what getting it wrong means. But the reality is, on a long-term basis, when we're looking over the next 3, 6, 12 months, a stronger economy will be better, because you'll continue to see profit margins wider. You'll see the labor force continue to be strong. The consumer will continue to be strong. And because you're already hearing a lot of this rhetoric around, we're going to have another earnings recession. Well, if the economy remains strong, then no, we're not going to. So I think all of those things long-term support equity markets to stay higher. I think it's just going to come with a lot more volatility as we head into a lot of just noise with the election and other things globally through the rest of the year.
So you mentioned earnings there. Bloomberg Analysis is estimating that companies in the S&P will report a 4.7% increase in quarterly earnings from last year. Are you feeling pretty positive about what we're going to learn in the days and weeks ahead?
I am. I mean, I think that bar has been lowered. It was, when you look at the mid kind of summer numbers, it was closer to 8% was what was the expected earnings growth year over year. So it has come down, which obviously lowers the bar for companies to beat. But like every earnings over the last several quarters, it's going to be really focused on what's next. And I think that the large focus is going to be on guidance of holiday season, consumers, what they're going to do. Are inventories going to be high, or are they going to, come into the holiday season with lower inventories so that they don't have to slash prices with sales? Those are the things I think that, investors are really going to be focused on. That's what I'm going to be focused on. And I think that's what we're going to see drive, whether we get, the so-called Santa Claus rally at the, in here at the end of the year. It's really going to be leveraged on the consumer.
You're a little cautious. You don't really buy into this rotation story, do you?
Not really. I mean, it made a lot of sense where, equities and large caps had run a little bit too far, too fast. Obviously all the hype around the Mag 7. So it made sense that people would start to take some of those profits and shift away. And that's really just profit taking. And then what are you going to do with those profits? Well, you're going to put them into some of the places maybe you're underweight because of the imbalance of your portfolio, where now you're way overweight growth stocks. But that's short-lived. And so I think we've already seen that flush itself out. And so I think, really going forward, you got to look at just large cap U.S. equities, because that's where the most value is right now.
Okay. All right, Adam, thanks very much for joining us. Adam Coons, Co-Chief Investment Officer and PM at Winthrop Capital Management.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.